Well, hello, everybody. Welcome to episode 70.
Dang,
That is
it's
It's a big
lot.
a
number.
good
Yeah.
number.
Yeah.
Yep,
Mm-hmm.
yep. So, a little celebration today. And the OG crew is with me Tyler, Keith, Kyle, and Lisa is trying to host this thing again today. Let's see how that goes. And I thought we keep with traditions, and the two truth and a lie seems to be a tradition by now.
Well, after people rip my head off about
About changing it.
it.
Yeah, we couldn't deal with the two lies and the truth.
Right.
It was too much for the morning. Anyway, I thought we do a Nvidia edition today because we have like a special day today.
Mhm.
Everyone is waiting for Nvidia earnings, and we're recording pre earnings. So whatever
Pre-report, yeah.
pre earnings record. Yeah, yeah. So whatever is upon us, we're I think still upbeat, right? So let's start. Number A. Nvidia was founded in 1993 and IPO'd in January of 1998. B. Nvidia took just 96 days to get from the milestone of $2 trillion in market cap to $3 trillion in market cap in 2024. Or C. Jensen Huang has an Nvidia logo tattooed on his arm in celebration when it hit a share price of $100. Let's start with Kyle. He's
Ooh.
nodding already, so
He's got this one nailed.
he's got it.
I know I'm nodding because I'm dazed and confused. I don't.
Then I did a good job.
Yeah, you did. I mean, in the value space, I'm not really looking at Nvidia, so I'm so sorry.
Come on, Kyle.
That being said, I'm going to say C because I don't know, and also $100 seems like a little light to get a tattoo on yourself.
Okay, C is locked in. Keith?
Maybe he's got a lot of tattoos, so it doesn't really,
Could be.
just one extra one. I'll mix it up. I think B, which as crazy as it sounds, the 96 days from 2 trillion to 3 trillion, I think that's actually true. And then Nvidia founded in 93. I my guess is you tricked up a date on that one, so I'm saying A is not true. I'm gonna
Okay.
say the tattoo. He's got tattoos probably.
Tyler?
Well, he's always wearing that like black leather jacket, so you don't know if there's.
Yeah, he's covering up the
Something on
tattoos.
it.
That looks
Yeah.
like a tattooed guy with leather
Mhm.
jackets.
Yeah. I could see it, I guess, with his personality. Getting just like stock hits $100 and he's full sleeve. Yeah. Yeah. I don't know.
I think it's like a big logo on it. It covers his whole back.
Mhm. So I'll go with A because I'm pretty sure B is. That sounds about right. So I'll go with A. Yeah.
Yeah, A is correct.
Mm.
A is the lie, actually.
Oh,
So
it is the
Nvidia
lie?
was founded in 1993. That is correct, but it IPO'd in January of 1999.
Yeah, I
Mm.
figure you
Yeah.
just
So 1
fly
year.
fox.
And Jensen Huang has a Nvidia tattoo, so that is true.
That
And
is
it's like
crazy.
the small logo, I think, on his upper arm.
Kyle,
Yeah.
see, $100.
Good for him.
Contrarian choice.
At $100.
Yeah,
Contrarian
at
choice goes up
100
another
bucks.
10%. I expect a big CC on your back or something.
Yeah.
I wonder
Maybe
what-
it's already there.
I wonder what the split adjusted price on that is.
Oh boy,
Yeah,
good question.
Right? Like, is it $2?
probably.
It's probably sub 10. Yeah.
Yeah. Dollar.
And it's straight.
$1.20.
Where's
Probably
Nvidia
should've-
trading at? Like 120?
Yeah, right around there.
Yeah.
So, yeah, pretty split. Good stuff. Good question, Lisa.
Yep. So, to get us a little bit in the mood. And now for our wait what topic, I thought I bring us a little bit of choice overload this morning. Because there's some news flying around that there are now more ETFs out there than stocks, which is crazy to me. So ETF counts now we have 4,300 ETFs available, and that exceeds the listed stocks, which is just 4,200. So big numbers, but still like ETFs, more ETFs than stocks, which is crazy. So, and it also is a dramatic flip, like from the 90s, right? I mean, we had the first
Mhm.
ETF launched in Canada in 1990, followed by the famous SPY ETF in the US in 1993. And since then, like in the 32 years, it's 4,300. And stocks kind of flipped. They went from around 8,000 listings to
Mhm.
4,200. So we have the complete different movement here. So what do you think that is? Or is that a good progress, or is it concerning? Let's start with you again, Kyle.
I think a big number of those are probably buffered ETFs. No, I'm kidding. Yeah, I don't know. I think it's probably endemic of a more structural problem. I mean, we've talked about this before, like, IPOs have really just tanked to zero in the last 4 years. So there's not new companies coming, and when they do come, they're $500 billion series funding for XAI, and they stay private, and they'll leapfrog any kind of public regulatory oversight or scrutiny. So I think why would you go public if you don't need to? It's just seems like a headache, especially if you can knock the cover off the ball with some of those valuations. And then, yeah, I mean, the ETF space, it's so easy. Everything's so turnkey now. I mean, you look at a bunch of the bulge bracket brokers like Goldman and others, and they have literally white label ETF accelerator shops where you can pay a nominal fee to launch your own ETF, and you can do it quickly, like in a couple weeks. So it's not surprising that you're seeing this.
And it gets cheaper.
And it gets cheaper and cheaper,
like
right?
The issuance and all of that.
Right. That being said, I think the number of listed will probably consolidate much like the stocks did. It's just a function of time. So, I mean, there is a cost to run ETFs, and if you don't have a certain gravity of dollars in them, then they will collapse over time. And so, yeah, I don't know.
I mean, you mentioned a good point. Like, it probably will be the same fate like with the stocks, that it comes down rather than it expands. Which brings me to my next question. Maybe that's one for you, Tyler, because there's so much ETFs out there, and they get more by the day. Which brings me to the question: is there really a whole lot more innovation going on, a whole lot more new stuff getting out that we really need, or is that just basically a recycling of old stuff, or like?
Well, I think it's a little bit biased just because you're
Mhm.
looking at US listed companies versus US listed ETFs. And US listed ETFs could include the entire fixed income landscape, the entire global landscape, right? You can buy an ETF for India, right? Or depending on certain areas or markets in India, right? Like you can break out India on your own, right? So I think it's a little bit biased, but as far as innovation, I think there's probably more innovation right now than there was the last decade. You're getting buffered ETFs that Kyle brought up, right? So we have our designed income portfolio structure notes. There's a ETF that now that ladders those out on a monthly basis. You've got fixed income has been pretty bland for a very, very long time. And now you're starting to get that market to open up, whether it's asset-backed, specific areas of the treasury curve, right? So I think there's probably more innovation right now than there has been the last decade, just because of the demand for it. And I think people are interested in becoming more knowledgeable about investing themselves. And so people don't want just the 1 to 5 year treasuries, right? They want to be able to pick, right? They're hearing about people like us or people on CNBC talking about, here's where you need to be in the yield curve, right? Or here's where you should pick your spots in the markets. Do you want technology? Do you want semiconductors within technology, right? So as people hear that, as people watch it more, as people become more educated, I think people are playing that game more of, here's where I want to position my own portfolio. And so it opens up the universe for some of these companies to be more innovative in what they're offering.
Yeah. I mean, that's a good point. To kind of, people want a little bit of hands-on experience, and they could get very granular, right? There is some weird stuff out there, and it gets weird pretty quick. Like when there are ETFs out there where you can focus just on pet care or on pet stuff. There's ETFs out there that focus on the meme stocks, kind of rally. I found one that is delisted by now, probably rightfully so, which was a breakfast commodity strategy.
I remember when
so you can
that
bet
one was
on your
all over
cereals.
CNBC.
Those
Oh,
are the-
really?
commercials for it all
Really?
the time.
Yeah, it's delisted by
It was
now,
right
yeah.
after COVID they launched
Mhm.
it because
Mm.
commodities were going crazy and
Mm.
someone had the good idea of investing in breakfast commodities.
Yeah. But Keith is like,
Probably made some money.
Probably.
speaking of diversification, because a lot of people have more hands-on experience, want to be a little bit more active rather than just passive and set it and forget it. And with all this stuff that is out there that they can choose from, I mean, often when you kind of see portfolios of self-directed investors, you see a lot of ETFs, and it seems very diversified, right? There are 10, 15, 20 tickers in there. But when you look a little bit underneath the hood on a holdings level, it often seems like, oh, there's no diversification whatsoever because it's all basically concentrated in the Max 7 or in some very large
Mhm.
concentrations, even though the ETF name would suggest differently. So is that an issue for investors how to choose? Also, when it comes to like the behavioral psychological effect, there's so much out there that they're just maybe paralyzed by the stuff that is out there, and kind of that it gets harder actually for them rather than easier.
Yeah, there's a lot of overlap in individual ETFs. That's and when roughly our business is 40% portfolios that are ETF based, 40% stock and then 20% on structured notes. So that being said, so when we do research on the ETF side of things, we make sure we analyze these ETFs and see what they own and how much overlap there is, and is that overlap wanted or not wanted, where I think a lot of individuals may not do that, right? So there's so many ETFs out there, and I think that's, Tyler's right. There's a lot of innovation, and there's still some innovation to come. I also think Kyle's right. At some point in time, we're going to peak and consolidate, right? Because there's only so many dollars that go around, whether it's stocks versus ETFs. I think stocks have kind of normalized the last, I'd say, 15, 20 years in that 4,000 to 5,000 range. So I think that's going to kind of stay. IPO slow right now, M&A activity when they come. So there's buying and stuff like that. But there'll be some new innovation. But I think that's kind of like the right number.
Mhm.
ETFs, I think at some point in time will probably go quite a bit higher, and then they're going to do the same thing. They'll consolidate. There won't be any money. They'll be, like you said, they'll be shutting down. But what we do, we actually look at these ETFs and see what they own and how much diversification. If, Tyler runs a couple of the ETF portfolios. If we want to have this exposure, well, that's good. But now we got to make sure other ETFs that, that we're looking at don't double that exposure or we're too concentrated at all. I'm not sure individuals necessarily are doing that right now. They may say, to Tyler's point, is like, I want to own this part of the curve or this and that, and not realizing that 2 or 3 other ETFs also have that exposure. So you just have to be careful, just like anything else. It's an innovative space, but at the end of the day, I think
There's
you're
a lot of
seeing
redundancy.
a lot of
right?
redundancy, and you're seeing ETFs that come out are ETF of one stock. I mean, it's kind of a little bit silly.
That's the
right?
next thing, is like it can get dangerous as well, because it's like there's a lot of ETFs happening, a lot of like very weird stuff with one stock levered double, 3 times levered and all of that, where a lot of people maybe be invested in it without really knowing what it does. And you figure that out when it goes south,
And
usually.
inverse.
And inverse and
Mhm.
all of that. It's like sometimes it's tough to even get into the details, what it actually does and what the mandate actually is. And I can imagine for retail investors, this must be really confusing sometimes.
Well, you also have to think like people love talking about the levered ETFs, right? I mean, you and I had a similar experience during COVID where they don't always work right? So
They don't over a long. They simply don't
we
over an extended period
I
of
think
time.
we were in the 3x S&P, right?
Why wouldn't we be?
Why not? But we were getting 3x down, but we weren't getting 3x up. We were only getting like 2x up just because of the volatility and the options profile that's in there.
I think they use swaps on them.
Yeah, like you can go through the gamma and the
Yeah.
deltas and but something was messed up in there where
Mhm.
you weren't actually getting the 3x upside. The other side of it too is if you're 3x on the NASDAQ can drop 20%. Like that, it's not
Happens, yeah.
out of the
It did just recently, right?
Just
April.
recently in April, right? That means your 3x levered ETF is down 60%. You need like 195% to get back to even, something like that, right?
tough.
Like that, and that means that the NASDAQ would have to be up whatever that is, 195 divided by 3, right? So call it 60%.
Mm-hmm.
Just to get back to even in your 3x levered product. Like that's where the risk lies, that I don't think people quite comprehend that either.
Mhm.
Yeah.
I do think that the concentration, some of these bigger ETFs, that kind of does move the market. I mean, good and bad, right? You're seeing a lot of fund flows in there. You're not just the underlying buying of Nvidia or whatever. I'm sure we'll get to it, but if it's in so many indexes, and if all of a sudden it has a bad core, or all of a sudden people start rotating out of whatever those ETFs are, that can impact underlying stocks as well.
Yeah.
Mhm.
And there's also like with the tickers, I mean, it's like a 4-digit, like 4-letter. It's like only so many combinations, but there's so much QQQ, QQM, VOO, VOOM, or whatever. Like there's so much, similarities that can confuse as well, like what it does, what it's actually doing, and maybe it's basically the same at the end of the day, right? For a lot of those products.
Yeah, ETF providers are, obviously,
Not very creative.
well, they're trying to look for
Right.
selling points
Yeah.
and right
Yeah.
their product. Mine's the S&P, mine's the S&P plus 2 stocks, whatever. Right? Everybody's trying to get that shelf space.
Yeah.
And that's what, again, on the more popular ones, the fees have dramatically dropped. And I think I'm sure we'll get to it, is the innovation coming around. That part of the reason innovation used to be just passive versus active. Now you're seeing a lot of these ETFs are active, right? Because I think the ETF providers want to show some value in how are they doing it, and so they're with the very interesting concepts as well. So they're
Well, I think some of these low cost providers have also realized that if they start bringing out active, they can charge more for it too.
Mhm.
So you get a little bit better margin on that, right? So what is SPY expense ratio, like 0.02%, right? So, and then all of a sudden you bring out a active S&P fund and they can probably charge 0.3,
Mhm.
right? So you goose up those margins a little bit, and you're probably not making a whole lot of trades in there anyways, and still can call it active. So,
but that's a good point. Like that's not only the innovation that we get more and more ETFs out there with more or less innovation, however you want to look at it, but also like the active versus passive shift was dramatic, right? I mean, first when ETFs came out, it was for tax efficiency, for being liquid, for being able to own the whole S&P 500 with a smaller dollar amount than you would if you would go out and kind of buy every share. And the first thing was passive, just tracking, and then investor kind of shifted into more active approach, which we see the issuance of active versus passive. So active consistently since 2020 outpacing passive ETF launches, getting more granular. But my question is, and that's to your point, they can charge higher fees for it. Sometimes maybe it's not as active as it seems, but there's some granular stuff up there. But and Keith, you came from the mutual fund world.
I did.
Where mutual funds are usually much more expensive than ETFs. They are getting less and less attractive. So could the shift to more active ETFs also be a reason of issuers trying to protect their margins and getting out active ETFs just because to kind of make up for the less attractive mutual funds?
100%. I mean, the mutual fund world is kind of a bit of a dinosaur. I don't think there's a whole lot of, haven't seen the study lately of how much flows in the actual mutual funds. Obviously, there's still some, but the new innovation, what they're doing is a lot of these firms are just packaging the mutual fund as an ETF. And now the balance is you were charging a lot higher in the mutual fund. ETFs are cheaper. So how do you cannibalize your business without eating too much? That's kind of the battle going on, besides all these other ETFs going out there. So it's an interesting concept. And I do think that's just generally going to be the trade, because ETFs are liquid, daily pricing, intraday trades, whereas mutual funds, price end of the day, not as tax efficient. You come to the end of the year with a mutual fund, you may get hit by a forced distribution. You didn't do any activity in your mutual fund, you've owned it, but all of a sudden the portfolio manager managing it may have done a bunch of activity, some capital gains were occurred, they distributed it out, and then you as the holder of a mutual fund, all of a sudden it's like, I didn't expect that. Now, whereas you own an ETF, if that activity happened, you know exactly what your price was and your kind of capital gains loss. You can do a better tax plan, your tax efficiency argument. So yeah, I think that's just the way the industry is going. I don't hear a whole lot of new innovation on the mutual fund side of things.
Yeah, right.
No, but they'll be around for a while.
Oh yeah, for sure. They're
Right.
huge. They were the market, right? So
Well, and just think about the revenue sharing for these brokers. like RIA space is very different.
Mhm.
Like RIA independent advisors, like ETFs is the way to go. But if you go to the wirehouses, your Goldman's, Morgan Stanley's, RBC's, like that is the revenue share is a big part of that business. And so they want to make sure they keep those mutual funds on the platform. So
Yeah, I don't think they're going away, but
No.
you're seeing internally
yeah,
the firms themselves, the mutual fund companies going, we need to get into the ETF space. And some of them are just creating a new one, or some just it's the same look-alike as what they're managing as a
Yeah.
mutual fund.
I think some of these companies are waiting on a decision. It might be from the
Yeah, it's
SEC
coming up, yeah.
to do ETF share class. So like
Mhm.
if you own the institutional shares of this mutual fund, you can swap over to the ETF share class,
Right.
which
Mhm.
I don't know how that would work, but
Yeah, because they'll tax, right? Because it's like you have.
yeah, because
I-
then,
you know,
it's daily, like more liquid throughout the day. I don't know how
Mhm.
that.
It'll be interesting
Yeah.
because it's the tax thing is certainly a headache of going back and trying to track things. And when I've owned mutual funds for years, and I end up selling it, it's a little bit of a
Yeah.
headache of how much capital gains you've paid, not paid, and trying to figure out the math on it. Whereas, it's a lot easier with an
Mm.
ETF stock, whatever. This is your price, this is your sell price. Figure it out.
I
And I
remember
mean-
at US Bank, we used to get a list from every single provider of here's how much capital gains you can expect
Mhm.
Huh.
for this year. And so if it was too big, we'd sell them out of the
Yeah, beforehand, right?
mutual fund beforehand.
Yeah.
Yeah.
Same thing as as a portfolio manager of a mutual
Mhm.
fund. That's exactly, we'd get a report come. Most mutual funds, the fiscal year is end of October, middle of summer. All of a sudden, you start seeing, oh, it's been a great year. Oh, by the way, you've had some turnover in the portfolio. This is what the distribution is going to be. Like, oh my goodness! So you'd have to start managing to that as well to kind of get that number. What Tyler's talking about.
Mhm.
Mhm.
So
And so more hands-on wishes from investors. That's why we saw more active share, I think, up from 2020, plus issuers being more protective of their margin. But Kyle, I also found a chart that I found interesting. It's also the ETF flows of institutional versus retail investors.
Mhm.
And that really shocked me because retail investors bought $200 billion worth of ETFs year to date in 2025, versus institutional investors actually sold 40 billion.
Mhm.
So is that again maybe can that be again a reason why that investors are kind of retail investors jumping in, buying the dip and buying everything
Yeah.
that is out there? Or what do you think can explain this trend?
Yeah, I think, I mean, it's a continuation of what we've been talking about for the last couple of weeks, and that is, the markets seem structurally different. We've talked about 0-day options. We've talked about COVID and the rise of the retail investor having more time at home. You have more kind of apps at your fingertip, more research availability than ever before. And I think social media really plays a big part of
Yeah.
it, whether it be the kind of the meme stock or whatever. But as you were talking about some of the kind of the cutifying of the names, the pause and the whatever, the boat, or the
Mm.
cereal commodity ETFs, like they put these little cutesy names on what the tickers are. It's almost like not a memifying, but a themifying,
Mm.
right? It's like all encompassed, it's all adjacent to each other. And it is, from a behavioral finance standpoint, everyone has their own, like,
Triggers.
right? And so being able to be sold something, that you see that's catchy and it's,
Mhm.
Memorable, seems like it shouldn't really be a big surprise that retail is in
Mhm.
here pushing things up. And, it goes back to the comments on the single levered names where people don't really know what they're
Mhm.
buying, but hey, my neighbor told me about this, cool new ticker, and it was Tesla 3X, or, whatever it was. Why not? I'll throw $1,000 in there. So
Mhm.
it doesn't take that many people to actually come together and put a very
Mhm.
small nominal amount, but in total, it adds up to a big amount. So I don't know. It doesn't seem like, it doesn't seem super healthy, but
Mhm.
I think it can definitely cut both ways, but I don't know.
Yeah, definitely. So yeah, very interesting then discussion about ETFs versus stocks issuance, and yeah, excited what the future might bring for innovation. I want to switch gears a little bit because today is a very special day. Like we said in the beginning, it's Nvidia Day. So Nvidia,
You hope it's special.
I hope we hope certainly the whole market, the whole world hopes it's special again. Nvidia reports its earnings after close today, so everyone is holding their breath, right? Because when we think of Nvidia accounts for around 8% of the S&P 500. That's the reason why everyone is looking so close to that. And also and I think a lot of people are not aware of that, about the influence of just Nvidia on the market return. And the S&P as of yesterday returned around 9.7%, and around 2.5% of that return is just Nvidia.
Wow, a quarter of it.
Right. So I think that shows like how high the stakes are again. And it's not also important for the stock itself, but also for the broader, like I said, for the broader Mag 7, the whole AI theme, which has an even higher weight in the S&P. Yeah, so long story short, to stay with the levered ETF theme that we just picked up, Tyler, are you buying for your personal account, just to clarify that, another 2x Nvidia ETF today or not? And why is that?
So
3x.
3x, yeah.
I'll actually probably be buying the inverse,
Okay.
2x inverse.
Heresy.
Well, so I already own, shocker, I already own a bunch of Nvidia. But I'm guessing that expectations are so high, right? Because you have the estimates,
Mhm.
and then you have the whisper number,
Yeah.
right?
Mhm.
And I think the whisper number has crept up over the last couple of weeks to a point that I don't know, even if Nvidia blows it out of the water, I think there's just going to be money coming out of it.
Mhm.
So are you hedge? Are you
So it'll
just
be,
gonna
kind of like a hedge.
just
Yeah,
a,
I could just
to
buy a put,
neutralize
yeah,
it? Yeah.
But
Okay. I see.
Okay. So not
if
overly
we're talking about buying
negative.
ETFs,
Yeah. You're not
I'd-
bearish. You're
Yeah,
No,
you're just
yeah.
neutral
Yeah,
at this
Yeah.
point.
Yeah, good clarification.
I'll be
Yeah.
buying 2x inverse
Okay.
probably
So
today.
hedge.
just to hedge it out.
Yeah.
And Keith, a question for you, because you look at this space very
Mhm.
close, because it's in a couple of your portfolios, and you're our growth investor
Mhm.
of the team. What do you think? Because I think it's not only important that Nvidia beats earnings or misses earnings. That's not the whole story, right? People get very, very granular and look at every single number and really dissect the whole report. So what do you think is necessary if it's doubted a bad quarter? And I think it does not take a whole lot, but what do you think, what
Yeah, they're-
investors are looking,
Well, they're
other than just beat or miss?
yeah, they're looking at a lot of different things. I think the expectations are for revenue. The standard consensus is like 53% revenue growth. I think next quarter, same thing, 53. Again, we're starting to slow off. You know, going from 180 to 53, which is still great for their size. So obviously the pure numbers. Then they're gonna look at like stuff like Blackwell integration. When's that coming? How quickly is it ramping? The other thing is the AI theme. How much are they gonna continue to talk about that? How important that is? China's another thing, right? Can they sell their older chips to China? Are they paying the government 10, 15%? There's a lot going on besides the headline numbers, but I do think they'll set the tone for the AI market. So I'm hoping it's a good quarter. I don't necessarily think it needs to be a blowout quarter for them. It just can't disappoint. Obviously, if it does, I think the whole market would kind of sell off pretty aggressively, especially since, like you mentioned, AI is kind of a theme that's throughout. And AI is starting to, you see some reports the other day that people are investing in all this AI, but they're still not seeing any returns. That was kind of an interesting, didn't get a whole lot of play in the media. I think it was MIT or somebody had the report out basically saying,
and how people are using it is like to check their weather and and get dinner recommendations rather than actually use.
Then it's helping enterprise. I do think it's going to be help. I do think longer term it's certainly going to displace a lot of things, move things around, make things more efficient. So, but for this quarter, who knows what the quarter is going to be. I'm hoping it's at least good enough that it doesn't disappoint the market. But I don't, as big as it is, it would be great if it's a blowout. Yeah, but I don't think we need a blowout because the market's starting to broadening out a little bit. There's other things going on, and that's kind of what investors, we talk about, this whole broadening out theme versus not. And getting 8% in one name in the S&P 500 is getting up there. It's at some point in time. I don't know if it's, when you look at a year or two or whatever it is, it may not be
Yeah.
this high. Maybe other stuff starting to catch up. Doesn't mean Nvidia is necessarily going to be a bad stock by any means. So,
Yeah.
but it's definitely the leader.
And it's also interesting, Kyle, when we talk about what analysts expected coming into the earnings season, like 3.84%, and that was kind of blown away.
Yeah, more than double.
Right. But Nvidia and AI gets always measured
Mhm.
differently. That's always kind of apart from the rest, basically. And when we look at the other hyperscalers, like the main customers of Nvidia, so to speak, then it wasn't that bad, right? So it should be at least in line. That's what I
Right.
expect, at least. Anything else on Nvidia and expectations?
I don't think so. I think expectations, like like Keith said, and Tyler, extremely high.
Mhm.
I think it'll be the whisper number is kind of an old concept, but it still valid. It does move markets, and they are. I looked at
Mhm.
them yesterday. They're high.
Well, so our buddy, like a good example of what the whisper number would be is our buddy Gene Munster over at Deepwater. He sends out a report on Saturdays, and his report on Saturdays was estimates are too low for Nvidia coming into the quarter, right? And then he goes through
The
why.
reasons why. Yeah.
Right. So estimates might not change, but the expectations get
Mhm.
Right,
bigger and bigger.
and that's what moves the stocks. It's not the stated. It's what that animal spirit is.
Yeah.
Right. It's like we're expecting this number, but we're really
We're expecting a 10% beat,
right
on the estimates.
Correct. Right.
and if they come in at 9,
Right.
well,
Well, I think the relatedly important part is the second derivative, the knock-on effects of if they even come in line, where if you're,
Yeah.
Tyler, if you were saying, okay, it'll be good, but it might not beat that lofty expectation. Think
The
about
invisible number, basically.
right. Yeah, the whisper number. But think about all the other related investment that has ridden the coattails of that. So
Mhm.
in industrials, there are tons of names.
Yeah.
Eaton is a great example where you saw like
Yeah.
a lot of volatility because of that. Modine Manufacturing, they do the cooling for the data centers, the Carrier and Lennox, and York at JCI, like they do all the data center stuff, and the cement makers, and the EMCOR, and all the infrastructure companies, the utilities, like all of those. And you can very clearly see in the
Mhm.
charts the ones that are AI driven
Yeah.
and the ones that are not. And I think if you have Nvidia take a even in line and there's a little bit of disappointment, you can
Some
bet
of
that
that air is coming out.
the air is coming out.
Yeah.
And to close it out, I want to ask you to make a little bet.
Oh,
We had
Okay.
Nvidia crossing 2 and 3 trillion market cap last year, all within 96 days, as we said in the beginning. Then we had crossing 4 trillion just a couple of weeks ago as the first company ever to do so. We're sitting at 4.3, 4.4. So when do you what are the bets? When will it reach 5 trillion?
Well, it's a lot of large numbers. It doesn't need to grow as much to go from
yeah. So
4
we're
to
what,
5.
is that-
After
Right.
earnings tomorrow.
No, I
Little
want to
less
ask
than-
the bet today.
Oh.
So a little less than 20%, right? So that would
Yeah.
be it's reasonable. I would say I don't think it's gonna be tomorrow. just saying, never know though. I mean,
But will it be
That
in
would be crazy.
2025 or
If
2026?
they got Blackwell ramped up
it could happen. Yeah.
and shipments going, you could see 20%.
Just put a date out there. I'll say early 26 if you want. If you're looking
26?
for something like that to be on
Kyle?
the record.
I'm gonna say December
Wow.
by Christmas.
By Christmas.
The
oh,
value
Christmas
guys saying
present.
growth.
Okay.
Oh yeah, that's
Yep.
So their next report will be when Q3 report will
well,
be
3 months from now, right?
Mhm.
Yeah. Okay.
So-
So November.
Yeah.
I'll go November.
I feel like we're playing prices
Yeah,
right
yeah.
now.
I'll go November.
Yeah, pretty
November.
much.
Okay.
Lisa, what do you want? You might as well stick something out there as well.
I go.
Never.
No, I
That'd be a
go.
bold call.
That would be a bold call.
That would be a bold call. That would be bad. I'm
Might
not.
be
I'm
good
not
for the market.
that
I
much
mean, but
pessimist. I would say you said early early
say,
26.
early 26, January, February. I'll take a
Okay.
February if you really want a month.
I say February.
Okay. We're
Yeah,
all about this. Not too
26.
far apart.
Yeah, not too far apart. A couple of months. Well, now we have to revisit then.
Yeah, we will.
Mhm.
Yep. So our bets are locked in, and let's see how that
Okay,
goes.
Valentine's Day will circle up.
Valentine's Day. It's Christmas or it's Valentine's Day. So let's see what Nvidia can do for us. With that, keep your breath for Nvidia earnings after close. And with that, we're back next week with a exciting topic. Goodbye, and like and subscribe. Don't forget that. Thank you. Bye bye.